Okay, good morning everyone and welcome to another webinar. My name is Reith. I'm the National Leader of Real Estate and Construction here at BDO, and I'm looking forward to having this webinar today talking about the rise of alternative assets. It's set to be a very interesting discussion. We've got some great speakers lined up for you today. Before we kick things off though, let's just talk about some housekeeping matters. As always, you'll be muted, but you can ask questions throughout. There'll be time for questions at the end. If you have technical difficulties, there's a button at the bottom of the screen that you can press to ask for support. And as always, we'll follow up with an email with a recording of today and details of the next webinar series and any follow-up that you need. So without further ado, let's get into our discussion for today. So with me here today, I have Kumar Kalyanakuma, founder and CEO of Acacia Capital Partners. Kumar is an entrepreneur and a leader in the Australian real estate industry with over 30 years experience in banking and investment management. He brings extensive investment management experience investing across all major real estate asset sectors, especially in the alternate real estate sector. Acacia Capital is a newly established investment management platform that seeks to invest in real assets with twin goals, and I'm keen to hear more about this. Twin goals of maximizing investor returns and achieving positive impact on the planet and people. Previously, Kumar was the head of Australia for AXA Investment Managers, Real Assets, and a co-founder of Eureka Funds Management. Kumar, I know this is a topic that you're really passionate about, and it's a real privilege to have you on this call. I'd also like to welcome Benjamin Martin-Henry, Head of Real Asset Research for the Pacific region at MSCI. Ben is responsible for producing thought leadership for the benefit of MSCI clients, covering both the major property sectors and newly emerging ones. Ben has over 15 years of experience in Australia and the UK across investment analysis, research, strategy, and product development. In addition, he has expertise in the property sector, performance metrics, macroeconomic and financial market data interpretation, and product development. I did listen to your Q1 update earlier, Benjamin. I think that was last week. And it's great to get your insights here for us today at BDO. Thanks for joining us.
Oh, great to be here. Thanks for having me.
You'll notice that we are actually sitting in the same room today, which is a bit different to what we have normally done during COVID and past then. So if you see us moving our heads, it's actually that because we're looking at each other rather than at the screen. So yes, you'll notice that throughout. So let's get into this. So alternative asset classes have been around. They're not new, but they're constantly changing. There's new asset classes coming up all the time. We're thinking of childcare centres in the past, self-storage warehouses in the past. They're still around, but the environment is constantly changing. Build to rent as an asset class is gaining in popularity to the point where we might actually call it a separate asset class and no longer an alternative. So we'll discuss that today as well. So Ben, why don't you kick us off? Help us understand, what do we actually mean by alternatives? Why do they exist? How do they come about? And yeah, what's the economic trend behind it all?
I always preface this discussion with, I don't mean to offend anybody when we say this particular asset class is alternative, because for some people it's not alternative, it is their bread and butter. I think it's self-storage in Australia, for example, Abacus, they're a massive player in that space. But these are mostly what we classify as alternative in Australia, your childcare, your self-storage, your senior housing, and indeed build to rent. I have been on a campaign recently to remove the moniker of nascent for build to rent, because I think we can move past that and say it is a bit more established. But there are various reasons why asset classes become more popular. We've seen over COVID, for example, the advent of self-storage. You know, heaps of us have to work from home. That second bedroom where we had bed, we couldn't accommodate two desk chairs, computer screens, et cetera, et cetera. So we all had to move some of our belongings into self-storage. And we saw self-storage really boom during COVID. And if you think about how industrial has developed, 15 years ago, a lot of people didn't think that industrial was a core asset class, and now it is core and has been one of the best traded asset classes for the last 2 or 3 years. So there is a constant evolution. So I've no doubt that in 10 years' time, we'll look back at these discussions and go, why did we buy that alternative? It's certainly not alternative anymore. It is certainly core. And yeah, economic drivers play a big influence in driving these alternative sectors.
Kumar, how would you add to that?
Jump in. At the highest level, the global institutional investors sort of look at asset classes quite different to the way sort of we are kind of talking. Today we are sort of down at the real assets or real estate level, and we're trying to sort of see within that what's alternate, what's core kind of a thing. But at the highest level, anything that is not conventional, stock bonds, are classified as alternates.
Right.
Secondly, typically anything that is illiquid in one's portfolio is considered as alternate as well. In that sort of context, whether it's crypto, private debt, or real estate, could be considered as alternate. And the other thing about what's within the real estate alternate depends on where you are, who you talk to, etc. So, for example, BTR, as Ben correctly said, probably that should be removed and it shouldn't be an alternate asset class. If you look at the US, that sector, they call them multifamily, we call them BTR, started in the 50s. And, if you look at some of the sort of transactions, data and everything else, often it actually outstrips office sector. It's, from a capital flow point of view, it is such a big sector. But here, because it only started, 5 or 7 years ago, we're all kind of trying to still get our head around what it is. So the point about, defining alternative depends on who is defining it,
yes,
for what purpose, and where it is that specific assets or the sector is.
Well, exactly. Your point on multifamily in the US, it's the #1 traded asset class for the last 3 years. And it is the most institutional investment for real estate in the US. I think it had almost $400 billion worth of multifamily trade.
And why do the investors like that? It's because it's granular income. There's no incentive involved. There's very little capex involved.
Yep.
When you have a tower with 200, 300 tenants, they're bound to pay the rent. You don't need to throw incentives and rent freeze and all of these things. Even though we kind of classify today, retail and office and even industrial logistics is kind of in that sort of core space. When you think about it, there's interesting sort of, plays in there with cash flows and incentives and rents and rent escalations and all sorts of things. That sometimes sort of, prompt me to kind of think what we call core is really core. Is it kind of moving more towards alternate real estate?
It really depends,
because there's business element to it. You're actually taking the risk of a tenant sometimes. All the capex that you're throwing in, especially if you take retail, all this sort of entertainment precincts that you're creating, you need a novelty factor constantly to keep the tenants coming back, not the tenants, rather the shoppers coming to the shopping center. There's so many things that are happening in the real estate space. And there's, in my view, a serious convergence happening between what is known as core today and the alternates. If you actually sort of strip the sort of layers and sort of look at the risks, the rewards, and everything else, sometimes you go, I would rather alternate than
the underlying business metrics. That's right. I mean, Ben, you mentioned earlier about industrial having come up, throughout COVID and really growing. And I suspect that data centers has a similar story, because as logistics grew, you have all the van brigade, and data had to increase because we had to we're buying everything online nowadays. So data centers increased. Do you see that as growing into a more prevalent asset class then as well?
Absolutely. It has been growing over the last few years, and not just the advent of COVID, but so much of what we do these days is online. Literally, we're doing it right now. That the lack of data centers has been a problem, particularly in Australia. Everybody always comes to Australia, laments the speed of our internet. It is quite low compared to a lot of other countries, and that is obviously a big part of that is because of the load put on these data centers. So it definitely is an asset class that seems to be growing. It's a relative, my understanding is, which is limited, it's a relatively straightforward asset type to run and to manage. So it certainly is something that we're seeing a big growth in the future. The other interesting thing about data centers in Australia is one of the reasons that FIRB can knock back somebody buying an asset is because of national security.
Yes.
I would assume that data centers will fall under some kind of national security remit, and therefore it's almost like domestic investors have basically a captive market just for them. They don't have to worry about offshore investors. So I think it's certainly one that's going to be growing over the next few years.
The investors love data centers because of that macro tailwinds that you all know what they are. But interestingly, investors are looking at it more as a platform play. They want to buy the brand, the business, and then they can just add more shares as they
yes, and scalable.
And that's the attractiveness of data centers. I mean, if you just say, I'm going to just have a data center in one building in Macquarie Park, that's just not an attractive proposition.
I see. Right.
If you have a brand, you can attract your Amazons and Googles and everybody else into your shed. And then you can actually offer them solutions, in every key city, including Asia for that matter. Then you have something meaningful, and then the returns are much better then.
So again, there's more to it than just having the building. It's about who's in it, what tenants do you attract to that, how do you build your brand, and how do you scale that up then, rather than just buying bricks and mortar.
And that's the thing about alternatives is that a lot of investors kind of like clean, safe investments. That's okay. There's a place for all of that in your portfolio. But when you get into alternatives, doesn't matter what they are, you've got to accept that it is complex, it is structured. There might be some risks that are not common to everybody, and that's why you need skilled people to run and operate.
I see.
And it will give you the reward if you actually know what that you're getting into,
what the peculiarities are, and how to drive them.
And increasingly we're seeing global investors are coming in and making direct investments in the core space, and that sort of puts a little bit of risk on the fund managers in this space, and anyone who can specialize in an area, who can have a bit of a dominance and a bit of track record and a team that is strong enough in that particular sector, could benefit from playing going hard and deep into the specific alternate space.
Interesting. Ben, anything to add?
Well, I think that's what we're seeing, because I always use this example of childcare, which really is a growing sector at the moment. We're seeing a lot of the instos get into that space, and the returns on childcare are pretty good. But if you're getting a 20% return on a $50 million portfolio, it's a drop in the ocean for a lot of these guys. So we don't have that scalability yet. But to Kumar's point, we're seeing someone like Charter Hall picking up childcare here, there, and everywhere over the last few years, really starting to build that scale. And I've no doubt we're going to see other investors do that in other alternative spaces, and eventually get to some kind of critical mass where, who knows, they may even list it. I know there was talk of Abacus listing their self-storage REIT earlier this year or late last year. We may get to a stage where it does become so institutional that we start seeing these listed players list some of these funds, or even getting taken over, which is again is a big way we see alternatives start to develop. These big portfolios getting acquired. Just look what happened with industrial in 2020, 2021. Every other day there was another industrial portfolio sale that I had to talk about, saying record portfolio sale, record here, record there, milestone. That's just how property develops. And we'll get to that stage with a lot of these alternative asset classes, I'm sure.
And going forward, I mean, you've got to believe in the alternative space getting stronger and better and more transparent, more scalable, and also more predictable in terms of returns, because there's a massive shift in the real estate space that is happening. And some of us don't want to accept that, but many of us know it is coming. I mean, it started with shopping centers and retail sector, 10 years ago, with online retailing, with COVID and working from home, all of that means, what is happening to office sector, and there'll be winners and losers within that. And then to sort of think about other sort of spaces that are emerging, like we talked about data center, and that's connected to technology. Beyond doubt, it will get even stronger. But in other spaces like life sciences, post-COVID, everybody's sort of thinking about science for change. And that's kind of an interesting one where it's research for the first time, in my life as well. Like we're kind of talking about science and research, but those kind of investments are going to be adjacent to universities or hospitals, so they're going to be a bit specialized and location specific. Then obviously, ATI is there, and healthcare in this country has been dominated by not-for-profits and governments providing the infrastructure.
Correct.
But we're seeing increasingly, private hospitals are being built and owned by private capital. Then with science and advancement with science as well, we're now seeing surgeries in pretty much every suburb. That is of appeal to investors because that's with science you can do a hip surgery and be out of the theater in a day, and you can do a hernia operation and out the same afternoon. A lot of advancements happening, and therefore you've got to create this new infrastructure and services to meet.
And again, it's a scalable model. You need these surgeries all over the place. Don't you? It's not everyone's going to travel to Sydney to have their surgery done. You need to have those scalable models.
That's right. But if you talk to people who have ownership of very large old hospitals, they go, most of the wards are empty because the turnaround time for a patient is getting shorter and shorter. So these are sort of interesting trends to kind of watch out for if you're going to play in these kind of spaces.
But I've never seen a newspaper headline saying we have too much healthcare in any country. I don't think that's ever happened before. It's just something
we have the right assets.
Yeah, it's just something we constantly need. Something like this constant chat about oversupply, retail oversupply of office. No one's ever said there's oversupply of healthcare. So it definitely is something that's going to continue to grow. And the returns on healthcare are absolutely phenomenal. If you look at over the last sort of 5-10 years, it's better to only buy industrial returns and not buy that much. And arguably, healthcare is a bit more of a stable income stream compared to industrial. Industrial will ebb and flow with economic fortunes, whereas healthcare, I'm pretty sure, should be a bit more resilient to those ebbs and flows from the wider economy. And it's a similar thing for a number of these alternatives. Senior housing, another great one. Aging population. It is very new in Australia. We don't have a heap of it, and most investments that we do see are companies buying into existing platforms. I think Aware Super picking up 2 shares in one of Lendlease's senior housing portfolios. It's getting into those safe sectors and get those solid returns. You're not having to worry about the actual running of the things. That'll come in time, but you don't want your first investment to be buying up a senior housing asset and then running it yourself. So I imagine there's quite a lot of complications there and quite a lot of nuances in there. So to one of Kumar's points before, it's not like you just buy an office and here you go, JLL, run it for me, and you take the returns. It is a little bit more complicated than that for some of these assets, and you have got to work at them. But again, it's evolution. We naturally evolve with these things. And real estate, again, will evolve. Some people may not want to, but it will evolve.
So it's really about picking trends or understanding the trends of our society at large, rather than picking an asset and running with it. You need to really understand the background as to what's driving it. So that's then suggesting that over time, as population growth, all these trends sort of keep on emerging, there'll be other asset classes that come out as the new alternative, and the current alternatives become more core assets.
Another point to sort of make is that sort of post GFC interest rates are really low. As a result, investment return expectations dropped to kind of almost 5% was a good return kind of attitude by some investors, and that's kind of where people realize, okay, where do I find superior risk-adjusted returns? It's a bit of an industry sort of phrase, or looking for alpha, and that's how I would say most of the alternate space that we're seeing today got a bit institutionalized, and professional fund managers starting to buy the portfolios and running them and expanding them. Now we're kind of at an interesting stage with the interest rates rising, the return expectations are higher. How these alternate spaces go forward, if it is just producing the returns they produced in 2015 or 18, how appealing they will be, and therefore people who are owning these portfolios need to sort of think about how they can actually extract more values out of them.
Okay. How do you see, Ben, you alluded to there's a difference between international global investors and local investors, and maybe in some of these asset classes the local players have an advantage, Do you see there's a market still for international investors coming in, maybe because of, we talk about the BTR or the multifamily investments in America or Europe for that matter, they already understand how the metrics work. Do they have an advantage in Australia because of that history?
I think so. If you look at the funding for a lot of these build-to-rent developments that are happening at the moment, probably 65 to 70% of it is offshore capital. Right. And that was pre this change in the MRT legislation where they were effectively paying a double the tax rate they would on an office building, for example. They were still willing to fund these assets and still keen to get into them because they know how well the asset class works overseas. When it comes to some of the smaller ones, again, if you look at the average ticket size for overseas investors in Australia, it's around $130 million compared to domestics at about 7. So as far as I'm aware, could be wrong, there aren't a lot of $130 million childcare assets at the moment. So for some of these smaller sectors, there's not a heap of offshore investment at the moment because you can't get scalability just by buying 1 or 2 childcare assets at $3 or $4 million. So it still is mostly a domestic market as it stands. Healthcare is probably a bit of an aside. We have the likes of Northwest, for example, they're big asset owners down here. So that's probably a slightly separate one. I'll put healthcare and built-to-rent in a slightly separate bucket. Yes. But the other ones is self-storage ones, still a little bit new for Australia. I know Blackstone has made some plays here and there in self-storage in Australia because they've got enormous RE&C in the US. But again, some of the smaller ones, pubs, we always call pubs an alternative asset class, but it's basically a stalwart in Australia. It's almost core. Overseas investors don't play in that space here. They don't quite understand how it works or why you'd want to invest in a pub. Diversified income streams, for example, is why we like pubs as investors in Australia. So I'd say for a number of alternative investments, domestics pretty much have the market all to themselves at the moment.
And maybe, as you say, once they scale up and there's REITs, you talk about Abacus, once that happens at that scalable level, you might see international investors come in and buy those platforms out rather than buying individual assets.
There are 2 things that play with international investors, and I'm talking about institutional investors. They want scale, but they love Australia for the transparency, the ease of doing transactions, and the competitive nature of our market, and the liquidity that is there. But they don't want to come into the alternate space without a strong manager doing there. And if you look at the boutique fund managers who are focusing on the alternate space in this market, they have all been backed by foreign capital.
I see. Yes,
it's very hard to get domestic capital, the institutional capital or the super fund capital to support some of these sort of boutique platforms.
Right.
But it will change. But as you said, Andres, the foreign investors have the advantage of seeing these kind of alternate asset classes in other markets, and they already have an exposure. So therefore, this is not something unique that you got to take it up to your investment committee to get it placed. So that they are kind of the drivers.
So you really, the perfect match would then be to get the local knowledge through a local fund manager, getting that global capital into a local player with the local knowledge and the local allocations.
And I think the other thing to note is that foreign capital is also wanting to have a say in the investment decision making when they allocate, $200 million to a fund manager. They're not going to sit back and read in the papers about the transaction that they did yesterday. They want to have approval rights. They want to make sure that the risk and rewards kind of all aligned, with the fund manager. So the structuring part is evolving, and it's becoming more and more like the US style fund structuring. Nothing wrong with it, because ultimately, capital is king, and you've got to kind of respect the fact that they're backing you when you're a small fund manager, and they're providing you with the growth and the revenue, and the fact that you can hire people and right people, and reward them accordingly. So that's the thing about the alternatives, that alternate space means everything is structured.
Yes, right.
Investment is structured. Returns are, somewhat sort of, it has a few more variables, but also the investment structure is also complex. There might be tax angles, there might be leverage angles, there might be limited investment life to sort of, exit and all of that.
Yes.
So it's worth sort of thinking about some of those kind of things as well when you want to go into the alternate space.
It still is. I mean, if you look at one of the products we have, the Real Capital Analytics database, for every single year over the last 21 years, the #1 asset class for overseas investors has been office, even with industrial over the last couple of years.
Okay.
There's still like this core quality, simple structure, simple asset class, just low money in office, away you go. Even look at the retail. Retail only accounts for around 7% of offshore investments. And most retail players is with a JV, with a partner, someone on the ground that can run this kind of stuff. And that's how alternatives are going to develop as well, I would imagine.
Fascinating. No, that's really good understanding and gives us the basis. Wouldn't mind doing a bit of a deep dive into housing a bit more. We've already touched on build to rent. Well, one of the things we said earlier is that it may actually be a class of its own. Ben, maybe asking you the question, do you see it getting to the scale of what we see in America and Europe?
Eventually, probably. It's going to take time. The US has obviously a massive head start on us. And I think when I was at my former place, we stopped comparing ourselves to the US because there's no point. We compare ourselves more to the UK, as they're probably 7-8 years ahead of us. We're kind of going on that trajectory, and we seem to be doing it a little bit better than the UK. But it's going to be one of those things that when people can touch and feel it, there's going to be more appetite for it. I do think people overcomplicate the build to rent space by going, oh, it's not going to work, this, that, and the other, we're different. It's residential. You know, if you put two towers next to each other, we have examples of those out in Liverpool. One developer owns both towers, one's built to rent, one's built to sell.
Right.
If you put Joe Blogs on the street having a look at both of them, what's the difference? You don't know what the difference is. This one I can rent in, away you go. That's all they're looking at. And vacancy being sub 1% in a lot of markets, there's no way this can't work. It's just small at the moment. It will grow, it will develop. And there's always this misconception as well, is that it's all big towers. 70% of multifamily in the US is below 3 stories. So it doesn't have to be big towers. It's just how it's developed at the moment. And the other misconception is it's all premium. It doesn't have to be premium. That's just how it is at the moment in Australia. It will all change. And it's entirely possible that we'll start to get some social housing in build to rent as well as the premium space. We already have some key worker provisions in some assets in Brisbane, for example, where 25% of the building has to be at 80% median rent for police, nurses, etc. So already it is developing that way. So I think it's going to be, it probably will play an important role in social housing in the future.
So that's an interesting point you make, because generally I hear that build to rent is not social housing, is not affordable housing. We try and separate those out, but you're saying that there is a bit of a grey area and it could sort of develop further. Kuma, what's your take on all of that? Affordable housing, social housing, build to rent?
I'll start by sort of talking about some of the things Ben touched on. In the UK, it's growing, and I think if you're kind of looking for some reference points, I think looking to UK is the best way rather than the US. As I said, it's a 70-year-old sector, you know, and in the UK it only started after the GFC properly. So that's that. BTR, you know, we call them build to rent, is only relevant when a sector is in its sort of early stage. You know, when it's all established and people are trading established assets, you know, it will become multifamily. Okay, but whatever the label we've put on, I think, as Ben said, you know, we'll go vertical, we'll go horizontal. We've got medium density, low density, high density, premium, you know, budget. We will have the full spectrum covered. Whether everyone wants to play in the full spectrum, or people want to kind of, you know, focus on, say, in a city premium 20-story towers and, you know, concierge services and all of that, time will tell. But in Australia is at an interesting stage in terms of the multifamily, because, you know, we're having very, very low vacancies. Rents are skyrocketing, which creates some social problems. And then the government needs to kind of step in and solve for it. The tenants who stayed in market rental properties, or the BTR, or, you know, the investment property that some of us might have, those people are, through the fact that rents are, you know, skyrocketing, and the income's not sort of, you know, catching up with it, meaning they are falling into that affordable category. There's a sizable crowd moving into that, which then becomes a government problem, because if you're charging 75% of market rent, for a tenant like that, who is actually subsidizing the investors to put the money in? Why should you do that? Investors have to get reward for the risk they're taking. So if one could build normal BTR and another one could build affordable BTR, where are you going to play?
Correct.
So I think we're going to see government playing a greater role in the rental space or BTR multifamily space, and there will be more subsidies. The fear that I have is going to be, it could end up being a dog's breakfast with federal government doing something which is different to what the state governments do, and then the local governments, the FSR, the planning approvals, everything could just come into play to solve the problem, but end up with a mess, and therefore unnecessarily the sector could have a regulatory risk.
Yes,
including, I mean, we have heard lately about people wanting to put rent caps on rental properties. In other countries, there are rent caps, and my fear is that we could see that happening in this country as well.
Right.
So what does that mean to investors? Because today the site that is approved for residential could be BTR, could be affordable, could be social, could be build to sell. Which is going to be more appealing to the landowner or the developer. And the second thing is, if your rent cap is going to be there and rents are not growing at the rate of inflation, then how is even the market BTR going to be viable? This is the challenge, because I kind of expected my hazy crystal ball said, when interest rates started to go up, I thought land prices will adjust. However, with immigration and low supply of new stock meant that the land prices are not going anywhere. Therefore, whether you're getting government subsidy or you're just taking market risk, I don't think BTR today stacks up. Because then we have this other issue of construction costs and that risk and what's the premium you're getting for that. So it's not straightforward as there's demand.
Yes.
1% vacancy. Let's just go and build. I don't know what the answer is, but something has to give somewhere.
Well, if you look at the number of construction companies that have gone into liquidation over the last 12 months, I think it's about 1,600. It's a tough environment for construction. I guess the only saving grace for the build-to-rent market at the moment is it's backed by the likes of Greystar, pretty large globally, Mirvac, Grocon. There are some larger players in that space, so hopefully those developments won't fall over. But yeah, I mean, you can be 100% correct. The barrier has not, the land prices have not adjusted, which just makes these returns lower and lower and lower. And it does get a little bit tight. And I'm sure some of these projects that were earmarked for construction over the last couple of years, perhaps they would have wanted to delay by maybe 6 to 12 months to see if the supply chain stabilized, but they just weren't able to. So they had to pull the trigger and just have to keep building just to keep them going. So, I mean, we'll, particularly me, seeing about build to rent being fantastic, but it's no different to any other sector at the moment. There are a lot of problems in that space as well, driven by the economic environment.
Even in the UK, whilst we kind of say it's a good reference point, and there's kind of 50,000 apartments being built and all of that, but the returns to investors haven't been that great. If you actually go and talk to investors who took big bets on London build-to-rent market, it hasn't been great. Time delays, construction costs, all of these things affect. And this is where the players in the industry, in the sector, need to be careful. Like, if you want to make the sector more appealing, just be judicious about what you do and how you do things.
Because you're saying that the danger is that government comes in, may help out some, not others, and it becomes a mess. Yes, it's about having a planned attack rather than a reactive approach by government to this.
But if it's then move to the social side for a second, just my pet space. The estimates say that the sector, social housing sector, needs $300 billion of additional investment.
Right, that's what it needs.
Yeah, and currently estimates vary a little bit, but roughly about 500,000 additional housing needed in the social space. it could be up to 800, 900, a million by 2038. I think I remember dates right. And that's a lot of investment needed. Okay, and social tenants, they're not going to pay you $1,000 a week.
That's right.
They're not going to pay like an affordable tenant 75% of market, but they are paying $200 a week. So, how is this going to stack up for a private sector?
Correct.
And therefore, what role will the government play? All levels of government play. This is, I would say, a massive agenda for Albanese government. They just need to sort this out.
Correct. So you're saying if there's a question mark as to whether BTR works, which is at the premium end, how do we then make it work, or how could anyone make it work at the social or the affordable side of things? It's a government issue, but obviously there's players like yourself who have a view as to what it could look like. Do you want to just sort of cover off on how could an investor make it work?
Okay. Well, I mean, it's good to see the federal government made BTR, MIT,
that's right,
compliant,
eligible,
concessional tax rate. That's great. Tick. But there's probably another 22 things to do. The second one is the HAP, for the Housing Australia Future Fund, that is stuck in the Senate. Whilst there's no perfect solution to this problem, as we discussed, and I'm kind of hoping and urging the Greens and the crossbenchers to kind of support that and let it through, because then the government will have a pool of money to provide subsidy for players to come into the social and affordable housing and build the inventory. If you look at the history of Australia, last 30 years, state governments have invested less and less money into adding social housing inventory. Okay. That has been the domain of the state governments. Okay, and they've kind of almost like disowned that thing, and they have portfolios that are almost derelict, and they need a lot of money to go into it. And everyone knows that without private sector participating in this space, it's going to get ugly. And that's why I think federal government level tax changes, great. HAF is a good starting point for probably, and Greens, I know we're right, but the HAF size needs to get expanded, but I'm sure there's a way to deal with that. But then the perennial problem of planning complexities in this country, in my view, is another handbrake. Nothing can be done in a hurry. I don't have a solution for it, and I think that will remain a problem for a long time to come. Then just availability of land for that kind of housing. State, federal government, everybody's sort of sitting on great lands. We just have to release. And I was talking to my son about the social housing topic the other day, and he was going, "Why is it so expensive in Sydney, Dad?" And I said, "A couple of $100 goes to the government for providing the infrastructure and the services before you could actually build the building."
Correct.
So should state and territory governments play a role in saying, if it is for social forever or affordable forever, you guys are treated differently to somebody who's building their own home or built to sell or whatever it is. So there are ways to deal with it. My fear is just tweaking here and there. You'll only create a bigger mess.
Interesting.
Yeah, it takes forever to get through this kind of legislation, because my comment earlier about there's never a headline that we have enough healthcare. There's always a headline we don't have enough social housing. It's been a problem that's existed forever. Why are there no better solutions? Why are we always chronically undersupplied? And it does come down to money, but Kumar, to your point, you can tweak some tax legislation here and there, change it, make it slightly easier for developers to do this. If the government can't build it themselves and do it themselves, and maybe get out the way or incentivize the private market to help a bit more with that. Because again, it's something that the problem's only going to get worse. I can't see the problem getting better, and certainly when I'm hearing and reading, the problem's only going to get worse. So we need to come up with these solutions. But just on planning, one council is different to the next council, one state's different to the next state, and then you have the federal government, and it just takes forever to get anything done. That kind of needs to change. I know they did in Victoria for build to rent. They fast tracked filter an application. It's like, why do you need to fast track these things? Why isn't it just not a smooth mechanism to get these things going through?
And one other thing as well, again, when we were all younger people, everybody sort of dreamt of having their own sort of backyard and quarter-acre block and standalone house and all of that. I just coming back to the solution, I don't think we need that kind of solution anymore. Even like building apartments with 3 or 4 bedrooms, is that really needed? Or are there too many single occupants in a building?
Yes.
Therefore, should we actually think about building one bedrooms than 2s and 3s? These are some.
It's a mindset change though, for Australians, though, isn't it? It's probably our biggest issue in Australia. We still have this view of I want to have the quarter-acre block, although that doesn't exist anymore. But you still have that dream of owning a house and a pool in the backyard.
I'm currently having this argument with my mother. We were house hunting the other day, and she's like, no, I need 4 bedrooms and a pool. And why?
Yeah,
Why 4 bedrooms and a pool? It's just that mindset
Yeah,
shift.
that's right.
I don't want to go down to a townhouse. I don't want to have my unit. I want to have my backyard. It is a mindset.
Especially for rental. It doesn't have to be that expensive.
Correct.
Because it becomes expensive.
Yes. So final comment on BTR housing. It's going to happen. It's going to increase, but some initial roadblocks, a bumpy road ahead until we can get some of these basic matters sorted out. But it is coming.
Yeah, and I think it will probably fall under a bigger banner for living space,
right?
As opposed to trying to go BTR, social, affordable, even boarding houses. I imagine now, should student housing be part of this category? So yeah,
it'll change.
And there'll be opportunities to make money as well.
Okay. Just in the remaining minutes that we have, talking about green assets as an asset class. I know we spoke earlier about AXA was in the paper of buying a green asset down in Adelaide area in a green triangle there. Major assets that was purchased there. What makes that work? Why are international investors looking at green assets?
Yep. Okay, that's an interesting point. Another alternate space. We all have heard of net zero target, and we'll get there by 2050, and there are interim targets at 2030 and 40, and different people have different sort of trajectory to get there. If you just take infrastructure, real estate kind of investments, they're generally speaking carbon negative. Okay, whether you just look at it as an operational carbon or embodied carbon, we are all in the sort of negative space. So we all have to kind of change the way we build, change the way we occupy spaces, change the way we sort of design things. There's so many things. Again, another regulation train coming at us. So that's one issue. So bigger investors, global investors, when they sort of look at their position with real assets, infra, real estate, they're going, how the hell am I going to actually utilize my portfolio? That's kind of one issue. Secondly, natural capital, they call them. So that sustainable agri, forestry, biodiversity land, all of them kind of sit under that. And that is uniquely a carbon positive space. So from a portfolio construction point of view and from a net zero achievement point of view, putting natural capital investments next to real assets helps you to kind of create this carbon neutrality, okay, very high level. That's one piece. But then within natural capital, then there are specific investments. So you can actually go to New Zealand today and buy an underproductive farm, and you can grow pine trees. After 25 years, you cut them and sell them to the mill, and it becomes timber. But because you could wait for 25 years to get your cash flow, and then governments realize that we need more forests for carbon sequestration to capture the carbon, we are going to incentivize. Secondly, there are polluters out there who need to buy offsets rather than getting their offsets. So this is kind of an opportune sort of moment for people investing in forestry to benefit from monetizing the growth of the trees. And then it's coming in the way of carbon credit units. So in New Zealand, it's got a deep market and you can actually trade. And in Australia, the structure is similar, but it's called IQ and it's slow going, but I'm confident that it will get bigger. There are similar arrangements in places like California, where you can trade. So to get to interim targets and the eventual net zero position, the view is that investors are going to be running around like headless chicks to buy these offsets. Okay, and where are they going to get these offsets from? These are the units they will buy. So there are institutional investors looking to grow trees and earn these carbon credit units. Either they can sit on it as an asset or they can trade and monetize it. So that's another thing. And then the sustainable agriculture, rather than all farming, you just buy farms that are managed sustainably, whether it's use of fertilizer or what you grow on it and how you grow things on it, all of that. And in fact, in some places, even like we are losing biodiversity lands, and you would have read about what happened in the Amazon last year, the fires and all of that. So there's a push by good investors to go, I'm going to go and grow trees in places where there needs to be biodiversity, and we need to kind of create what we destroy, kind of thing. So in Australia, if you want to grow natives in some places, you can actually get carbon credit.
Right. Okay.
So it's a complex space. It's an emerging space, but it'll actually will become an important space.
So earlier you spoke about in the rental space, if I've got an investment here that gives me 100% and here an asset that only gives me 75% return, I'll go for the 100% return. Yeah. So it needs to make economic sense as well. Ben, do you have a view? Do these green assets actually make economic sense, or is it just so I can sleep at night?
Depends on the type. So we have a thing called transition risk, which is effectively governments change their policies as to around what kind of temperature increase they're targeting. I think the Paris Climate Agreement was 3 degrees, I think it was. But some companies have different targets. In order to achieve those targets, they have to decarbonize their assets. So there's a cost to that. There's a cost of the overall, generally quantified as the percentage of the value of the asset. So that's a way to lose money. Then there are other ways, such as farming. Now, I was at a presentation the other day, and one of the large Australian owns a agricultural building, wrong word to use because it's just this fascinating plant, where it grows tomatoes. Now, 90% of Coles tomatoes comes from this one asset. Now, this is an extraordinarily well-performing asset, and it's all hydroponic, it's all solar, it's extremely green, it's very good for the environment, and it gives back, it grows tomatoes, which then, of course, we all go and eat. And it makes, the returns on this thing are phenomenal. So there's a way to make a lot of money, but also do a lot of good stuff for the environment and people's well-being, onshoring food production, of course, which is national security, et cetera, et cetera. So there are ways to make money, but again, it's taking that. So this asset had a bit of a convoluted history. A US investor built it for 300 odd million, couldn't run it, didn't know how to work it, sold it for 70. Then this other company bought it, couldn't figure it out, sold it for 90. And then the current investor runs it perfectly and has all these deals with Coles. It's complicated. As we said at the start of this, alternatives are a little bit harder to manage. You need to work out and know what you're doing as opposed to just going, here, this is my building. So there are ways to make money, but it's a little bit harder than your traditional asset classes.
Yeah, I see. Kumar, anything to add to that in terms of the monetary aspect?
I think the terms are there, but again, you've got to pick the right type of investment and partner with the right people, especially if you're a foreigner or you're an institutional investor. You're not going to, rather Adam Williams and put a hat and be out there. So therefore, partnering with the right people with the right skills is a very critical piece when it comes to forestry and agriculture.
You mentioned in your, when I read your intro, you said your current role tries to, it has two aims, to make money for your investors, but also do the right thing by people and the environment. So you are looking at combining those two aspects, aren't you?
And it is, so I'm actually making my life quite difficult by sort of saying I could have these two roles.
Right, yes.
But it can be done. So social housing is a space that, we're seriously looking at, and subject to, government playing a role, the numbers will make sense. But more importantly, that's the first thing. If the numbers make sense, then we have to build everything from scratch anyway. So we can build the greenest building possible. We can offer a social program for these tenants so that they have training, employment opportunities, or just they feel great about being there. Safe and secure place. So I think you mentioned, Ben, about a lot of people to talk about ESG, but they actually mean E.
The E, the social.
So when it comes to social housing, the S is very pronounced and sort of, and a massive opportunity for somebody like us to actually play a role and have a positive impact on these people. And interestingly, global investors are kind of interested in all of these things when it comes to impact measurement. So if we are to build a social housing tower and we put the tenants in there, we overlay with the right kind of social programs, and we kind of measure outcomes, measure progress, then we can actually show the clients that, hey, I could have just gone and done a built to rent in Piedmont and it would have been very simple, but we took the harder part because it is the right part. So we actually got you the return that is equivalent to a BTR, but on top of that, we also achieved social outcomes for the people who are there. So that's kind of one example of it.
And I get the sense that investors are more and more asking for that sort of return as well. It's not just about the dollar number.
Yeah, even the banks, if you actually went to them and if you actually present your proposition the right way, it's a bit like the green bonds that you would have heard of. They are a greener or socially sort of aligned loan facilities that you can actually get from the banks, which are slightly lower in terms of margin and borrowing costs. So it's not only the investors who are keen on it, but also other stakeholders are interested in and very supportive of these kind of things. My view is that today it's a bit of a niche space, but given another 10 years' time, it'll be the new normal. Every investor is going to ask for the same thing. Every fund manager needs to have, the tools and the focus and the culture to kind of, produce both, the dollars and the ESG outcomes.
I think people are more conscious about these things, particularly investors. You mentioned impact investors. There was a company told me a couple of months ago they could have bid on an office building, very solid office building. It's going for pretty cheap. It would have been a terrific return, but the 90% of the building was leased to a military tenant, and they walked away from the deal because they said that's not what our investors want. Whilst the money is there, that social side is how you're making this money. People building weapons and guns and the like. So they walked away from the deal. So it is becoming much more important. It's becoming the forefront of investors' minds, all of this ESG stuff.
And globally as well, as a result of this level of interest from global investors, there are bodies, maybe this is something for MSCI too, actually doing a bit of an assessment of each and every investment and saying, what is the E outcome, the S outcome, and the G outcome.
Right, yes.
But then also every so often you can actually measure against your target, and they've got some tools and stuff.
Okay, right.
ESG ratings, we do that. We produce various indices that have cover ESG ratings. You give certain companies a rating, they go into that index, and then other companies benchmark themselves against clean companies. So it's exploded over the last decade or so, and it's good that it's becoming more and more important. It's not just passed off to your humble researcher. It now forms a part of the investment committee's decision-making process.
Kumar and Ben, this has been a fantastic discussion. We're coming up to 5 minutes to go. I'm wondering if you had like a final comment. How do we wrap this webinar series up? Kumar, if I can ask you for a wrapping up comment.
Okay. Alternate space is here to stay, and it's going to grow. There's money to be made, and you can only make money if you know what you're getting into and you're partnering with the skilled people.
Fantastic, thank you. Ben?
Agreed. If you look what's happening in the core sectors, are all kind of yielding around that same area. So people are starting to invest in the more alternative spaces. It's only going to grow. We've seen how the property industry has evolved over the last however many years, where some assets start off as very alternative and very niche, and then now core sectors. And that's exactly what's going to happen with a number of these alternative sectors at the moment.
Fantastic. So I learned a lot today. You know, the complexity around it, the need for specialized knowledge and being on the ground to be able to see what's happening, what trends are shaping the environment. I like that last discussion that we had about doing the right thing by our environment and by our community can actually make economic sense as well. And so I really like that that part at the end that we had. So that brings us to the end of this discussion. Thank you so much again, Kuba and Benjamin, for joining us. Thank you everyone else for listening. I hope we got through some of the questions that were asked. If there's any others, please email them through and we'll try and get a response to you. And so just to make note of the next webinar in our series talking about innovation in PropTech and ConTech, that should be interesting. We've got one of my partners up in Brisbane who's involved in that, who'll be talking to that with one of his clients. And then the other topics coming up, regional growth, and again, ESG value proposition. I think ESG is here to stay. We'll be talking about that for you know, for a number of episodes. So following this webinar, you'll get an email from us. If you could fill out the short feedback survey, that would be really appreciated. And we look forward to seeing you at our next session. Thank you very much. And thanks again, Kumar and Ben.
Pleasure.